Over the past 8 weeks, the Nasdaq composite has dropped more than 10%. Trillions of dollars of paper wealth have vanished, marking the index's second official correction of 2026. The damage is highly concentrated. In single trading sessions, major hardware manufacturers took violent hits, with companies like Dell dropping 8% and Intel falling 6% overnight. Typically, when numbers fall this fast across major indices, it signals a broad economic sickness, a recession, rising unemployment, or failing supply chains. But the rest of the economy is currently functioning at a normal clip. Investors aren't running away from the stock market because they fear an impending economic collapse. They are isolating a very specific, acute financial risk hidden entirely inside the technology sector. The anomaly becomes clear when you look at the industry leader. During the exact same weeks that chipmakers and software giants were bleeding value, Apple reached a historic $5 trillion market capitalization. This gap between Apple and the rest of the industry suggests that Wall Street has stopped looking at AI as a monolithic win. Investors are beginning to separate the potential of the technology from the massive, specific costs required to build it. The total bill for the artificial intelligence infrastructure race is massive. By the end of 2026, corporate spending in this sector is on pace to hit $870 billion. That bill is being paid by a very small group. Out of that total, just 4 hyperscalers, Amazon, Meta, Microsoft, and Alphabet, account for roughly $750 billion of the expenditure. This capital is flowing directly into physical concrete and silicon, specifically tens of thousands of custom microchips and the massive data centers required to house them. For years, the market consensus was that these corporations were so wealthy they could fund this entire physical expansion using the cash they already had in the bank. New data suggests that assumption was wrong. In the first half of 2026 alone, those major tech hyperscalers issued $250 billion in new corporate bonds. To put that in perspective, that single 6-month spike exceeds the total amount of money these companies borrowed over the entire previous 5 years combined. The wealthiest corporations on the planet have shifted their strategy, turning to the debt markets to raise record amounts of external cash to maintain their pace in the AI race. This shift changes the risk profile of these companies. On the left side of this flowchart, we see what happens when a company funds an experimental technology with cash. If the product fails, the primary consequence is simply slower growth for the business. The debt scenario on the right is different. If a company funds that same experiment with borrowed money and the product fails, the company remains trapped by fixed debt payments, gambling with money they owe rather than money they have. This explains why Apple was recently rewarded. By avoiding massive physical infrastructure spending, Apple protected its balance sheet from this cycle, signaling that Wall Street now demands financial discipline over blind spending. Taking on billions in new corporate debt is risky in any environment. Those rising energy costs trickled down to shipping and everyday retail shelves, right as the average household absorbed an additional $1,100 a year in living expenses due to a new regime of international tariffs. With consumer budgets stretching and commodity prices climbing, the economic environment has shifted. Wall Street has lost its patience for risky, debt-fueled corporate experiments. The market's period of blind trust in the AI sector is over. We have entered an era of permanent recalculation regarding fundamental financial risk. The most important metric to watch for your own portfolio is no longer the next software demo or product announcement. It is the steady rate of corporate bond issuance. If these tech giants continue to fund their infrastructure by borrowing hundreds of billions of dollars through the second half of the year, the recent 10% drop in the market will be the beginning of the volatility.